So let's chat about Todd Combs. He doesn't really need an introduction, but for those of you who don't know, Todd Combs is often mentioned as the potential successor to Warren Buffett as the next chief investment officer of Berkshire Hathaway. In addition to managing Berkshire's equity portfolio with Ted Weschler, Todd has been the CEO of Geico since January 2020. Recently, he made a rare appearance on a podcast. Let me share with you what I learned and my take on his viewpoints. So Todd's parents didn't go to college, which put immense pressure on him to succeed and grab the opportunity they missed out on. Thankfully, things worked out really well. Todd was the first in his family to attend college. He received his undergraduate from Florida State and his MBA from Columbia Business School. And many will say now he has secured the best seat in the world of investing, where he has unparalleled access to Warren Buffett and Charlie Munger, and he gets to collaborate with Ted Weschler to oversee the deployment of capital with a genuinely long-term perspective. In his journey of establishing himself in the world of investment management, Todd had to leverage his expertise in the very complex realm of insurance and his specialty in the broader financial sector, and his experience in data science at Progressive provided that unique edge against his competitors. And when he decided to pursue a transition to the buy side via Columbia Business School, Todd negotiated a asymmetric risk-reward situation for himself, where he can return to Progressive if he found it really challenging to break into the buy side. And typically, breaking into the buy side requires some good timing, especially for non-traditional candidates like Todd. At the time, Progressive, the company, did not do investor calls or callbacks and provided no guidance. And the managers at Progressive who wrote Todd's CBS recommendation letters, they suggested Todd talk to Wall Street analysts about Progressive. So Todd got in touch with Weston Hicks at the time, who was the number one II insurance analyst. And Weston then put Todd in touch with the Tiger Cubs, who were then actively researching insurance company and shorting some of the stocks in the sector. And Todd's knowledge of the intricacies of the insurance industry played a big role in helping the funds build conviction in a specialist sector. And that expertise really set him apart, where very few people are interested or are qualified to understand what Todd understood. So during his time at CBS, Todd was able to work at Blue Ridge Capital, founded by John Griffin, where he collaborated with his mentor Peter Danaker, who specialized in financial institutions for John Griffin. And after graduation, Blue Ridge was kind enough to provide job leads to connect Todd with funds who are looking for a financial institution specialist. Even with all the good things that had already happened to Todd, he was constantly seeking to expand his circle of competence, and he was really focused on understanding things from a first principle perspective. With that, he voluntarily enrolled in specialty finance courses at NYU in the evenings and on weekends to learn about credit card collateralization, which was a course targeting investment bankers who do that kind of transaction work. But for Todd, he really wants to fill in the knowledge gap in his financial institution specialty when he was lacking knowledge in consumer finance. It just really shows how much respect he deserves for not taking shortcuts, even when he could. Investing is simple, but not easy. So Todd argues anything worth pursuing in life is rarely straightforward. Many people are looking for shortcuts to achieve short-term gains, and he wants to caution you against such shortcuts. From my experience, when you found yourself asking a question about what is the quickest way or what is the easiest ways to do something, it's a sign that you're seeking that shortcut that I can guarantee you does not exist. As a long-term investor, Todd finds it more manageable to predict the long-term outcome of a business than the short-term. Of course, that's a perspective that sets him apart from a significant portion of the equity market today and probably going forward. Todd didn't offer any groundbreaking insights you haven't heard before. Success boils down to curiosity, hard work, sound judgment, intelligence, and clarity of thought. When those qualities compound over time, they lead to remarkable achievements. So what is holding most people from succeeding though? They don't push themselves hard enough. Todd highlighted 90% of success actually hinges on your mindset and your ability to just keep pushing, even if it's just 1% more each day. If you do that consistently, it compounds over time, setting you apart from your peers. Kobe Bryant, the legendary NBA Hall of Famer who tragically left us too soon, he talked about outworking others consistently, making it impossible for others to catch up over time. when two wildly successful people make the exact same point, it's a recipe worth following. And you should follow Charlie Munger's advice and strive to go to bed just a little bit smarter every day. Just like the network effect in business that grow exponentially, the latest work of mental models popularized by Munger suggests that knowledge does scale exponentially. But unfortunately for most of you, you lack the work ethic and the consistency to reach that exponential phase of growth. That's why influence and wealth tend to concentrate in the hands of only a select few of individuals on this planet. Todd definitely aligns himself with the camp of generalists because that's who he is. Drawing inspiration from David Epstein's book, Range, Epstein highlighted that generalists may progress slower at first, which is kind of similar to delayed gratification. Todd views the world of investing as highly interdisciplinary, and he is aware that as a non-traditional candidate, he had to build a framework over time. And what propelled him forward was his unwavering passion and determination. And I can personally relate. When I looked at a 10K for the first time in my life, I had absolutely zero idea what to pay attention to and what's the end goal. However, I didn't give up. I kept reading more and more 10Ks and investment books. Gradually, the clarity emerged. I gained the framework to conduct the due diligence on companies and industries. Again, showcasing you the effect of delayed gratification that is actually there as long as you keep working on it. For those who are just really curious about everything in life, which is an essential quality for fundamental investors, the challenge lies in striking a fine balance between your broad interests and your narrower circle of competence when you need to take an action. So you need to know what you want to learn versus what you actually want to act on, because the latter really requires you to know exactly what you're doing. Nevertheless, Todd does believe curiosity offers its benefits, as prior knowledge can be an invaluable asset in understanding a next situation. And a generalist pattern recognition actually carries across industries versus a specialist who have their pattern recognition within their own industry. Todd also talked about the importance of not underestimating your current work environment, even when it's unconventional and not directly related to what you want to do in investment management. The point being, every experience in your life can be a building block for the future, and you just never know. And Todd's experience as a bank regulator really proves the point. It didn't have the glamour and the perceived prestige, but it offered Todd a unique opportunity to interact with bank management, almost like having management access as a buy-sider. And he was able to sit right across a bank CFO and ask questions for hours. That actually gave him very valuable experience very early on in his careers compared to his peers. For the longest time, a common issue among college students is the tendency to back off by chasing prestige and pay with these resume-worthy names like Goldman Sachs or McKinsey. And Todd, on the other hand, argues that tangible industry experience holds far greater long-term value, such as operating experience in these industries that are not typically provided by traditional high finance roles. And Todd cautions against pursuing wealth or prestige because people change and evolve over time. And these pursuits yield short-term results, but they don't lead to the exponential growth where you can gain outsized wealth and influence. And he draws a parallel to the power law concept, where significant rewards are actually reaped by people who achieve those exponential scaling. Therefore, you gotta discover what you're truly passionate about and pursue it vigorously. That principle very much applies to an investment career. Only those who are passionate and continue to work on their craft will reap the biggest financial reward. So you should really embrace the possibilities and remain open to changes in your career. I personally really echo Todd's comment here. That's why I have been a big advocate for Bernstein's equity research business model, where they hire industry experts instead of financial wizards to cover their respective sectors. I feel only the industry experts know the true nuances of their industries and be able to generate great insights for investors. That said, I don't blame aspiring candidates because their behavior are really as a result of how the industry is structured, where firms value rigid prerequisite work experience, and the concept of exit opportunities is just heavily imprinted on candidates' mind ever since they step foot in their college campus. Todd's background in hedge fund made him believe the value of short selling. Of course, Buffett and Munger have encountered their fair share of challenges when it comes to shorting stocks, which made them disagree with Todd on this subject matter. Just to underscore how difficult it is to short sell, Todd suggests that one needs to be 85% correct on the short side to generate profits, versus a successful long-only investor need to be only 55% of the time right. Short selling, in Todd's view, requires a high level of expertise and precision. He does believe short selling can help one become a good investor on the long side. From my personal experience working at a long-short hedge fund, I also did not enjoy short selling, but I do appreciate the philosophical argument that a long thesis is really solidified when one can conclusively refute the short thesis on the exact same name. Todd had a pretty successful and profitable experience running his own hedge fund. He again emphasized the importance of truly loving your work in a very competitive industry. Like many successful people, he advocates for risk-taking when you're younger, as the downside is more limited. Asymmetry is also a concept talked about by Nassim Taleb. When you have higher net worth or have higher earning power, the less asymmetric your risk reward becomes, and the more fragile you are to changes in conditions. And in the business world, this concept is similar to the idea of counter-positioning, which I talked about before in the 7 Power Framework video, where a disruptor has a lot less to lose by challenging the incumbents who risk losing a big portion of their revenue, which makes risk-taking a more favorable strategy for the disruptors. And the same principle applies to you when you have a lot less to lose than if you have a high-paying job and family obligations. That's all I have on this matter. Please comment in the video description to let me know what you think. Now, if you want to hear more of my take on the investment management industry or other industries, I have 2 great videos for you in the upcoming screen. Make sure you check those out. If you found this helpful, please give it a like and subscribe to my channel for future contents on equity research, business analysis, and career advice. With that, I'll talk to you next time. Peace.